So we're very privileged to have Duncan. Duncan's a head trader at Wizard Trading Strategies. Holds a CFA. Does anyone know what a CFA is? A few of you. It's very, very difficult qualification to get. What's there, like a 30% pass rate? Yeah, it's a very tough one to get, but that's only one of the minor accomplishments that Duncan's had in a very, very short career. Back in 2002, I think you started trading warrants. 2009 was the head trader across the FTSE and the DAX index for the firm over in London. I forget the name of the company. Yes, Schneider. Not only that, but the trading track record, I can't even mention the figures, but they're very, very exciting. So that's why we're excited to have Duncan along. So if you could please give Duncan a very, very warm welcome.
Oh, big turnout. I mean, the human brain is an amazing thing. Normally, it functions perfectly well until I get up on the stage and try to do a presentation. Now, I would like everyone to take a moment and just to put on your investment hat and try to think. Let's say, hypothetically, I'm telling you that there is a product, investment product, that statistically is going to behave like this over the years, right? And that's what the price pattern is likely to do. And I'm asking you, would you be willing to get into the market at this point, right? How many of you think it's a good idea, investment idea, to getting at this price when you just had a rally?
And you know this forecast.
This is not a forecast. This is just a statistic. Shows on average the price is likely to do this in the past. Right. So how many of you think it's a good idea to getting at this point?
You would try to, but you'd probably enter in at 4 and think who pays.
Right. I think, well, certainly I did, because it's actually a marriage chart. That shows the life satisfaction of average man 4 years before marriage and 5 years after marriage. It's not a very good investment.
That's on calculation more than
Let's not get too dark here, all right? We still have some singles here. I mean, we still got a bit of hope, right? So the point I try to make is, we as human, we're not a natural investor, all right? We're not designed to be a good trader or a good investor. We are designed to experience life, to learn, to think, right? And I think most of the people were probably getting at this level, and the people getting at this level because there's a few behavioral biases that exhibited, right? Because they just had a really good relationship and it's overconfidence. They think that it's going to continue forever, all right? And at this point, because everybody's getting married, hurting, all right? They start thinking, well, everybody's doing that, so I might also just get married as well. And then after that, they didn't put a stop loss, apparently. So that's why they say, you know, trading is like relationships. It's really easy to get in and really hard to get out. My name's Duncan. I'm a head trader of Wizard Trading Strategies. I'm a future trader, and we manage capitals for wholesale clients. And today, obviously, we're not evolved to be a trader or investor. And today I'd like to share a bit of experience with you guys in investment behavior and risk-taking, because trading is all about taking risk and dealing with uncertainties, and which we are not very good at. Now let's shift gear a little bit here. Let's talk about money. I mean, money is just very serious stuff. I think it's a very serious topic. And I got into trading because of money. I mean, how many of you got into trading because of money? Let's be frank, right? I mean, if you got into trading because of, you know, you think it's an addiction or a hobby, it's going to be a very expensive hobby. And so, I mean, obviously, you won't be in the trading for the thrill, because there's so many other things you can get thrill from. Trading is not a very appealing one. So I guess everybody loves money, but I can't help but to think, 96% of Forex traders losing money, and that means they must, if the quote was right, win or lose, everybody gets what they want out of the market, then everybody must hate money so much. That's why 96% of people are losing money, right? So who should we really blame? The market?
4%.
Right? 4%? It's you, and it's me. All right? Because we dictate, we control our behavior, and we control how we react. We don't really trade the market. We don't trade market. Okay? We trade our beliefs about the market. So there are three things I would like to share today. First of all is the importance of having a market philosophy. And the second thing is how your trading behavior is sabotaging your performance. And then the third one is a bit of introduction to market profile, which is I found it's a very useful tool to understand the market behavior and try to understand who's actually involved in the market and pushing the prices. Let's start with market philosophy. Philosophy is a set of principle and a set of principles that guides your behavior and guides your decision. And when it gets to financial market, I think it's very, very important because it is the foundation of your trading style, of your trading strategy. Now, market philosophy consists of three parts: the world, the market, and yourself, right? And everything is actually, this diagram should be upside down because the first level is all about your understanding of how the world behaves, how the world operates. And the second layer is how the market operates, what do you think how the economy will operate. And the third layer is self-management, how much you understand yourself and how much you understand your behavior and your risk appetite. And one thing leads to another. So the worldview builds the foundation for your market view, and the market view dictates how you behave. Now let's look at the worldview, what's involved in there. I'm just going to quickly get through the market behavior because we've got a lot of things to go through today. Now, worldview is how you perceive the world and how you perceive the reality. And believe me, it's very important because trading is really tough. And at one point or another, after you having a losing streak and your confidence is really low, and you will ask yourself, what am I doing here? Why am I doing trading? Does it really matter that much to me? Do I really have to put up with so much stress? And you have to go back to the very, very basic question, what you believe is true, what you believe is what you really want in your life, and what is the meaning of existence. And that has largely to do with your religious value, your upbringing. For instance, I'm from China, and my family is really a conservative family. So I think that the world is it's what you believe is to be, and we have a very, very different worldview to the Western culture. So a different culture will have different worldviews, and my worldview actually dictates my market view. Market view is about, do you understand the economy? How do you think the economy works? Every successful investors will have their market philosophy. Warren Buffett, Ray Dalio. Different people will have different value in terms of how the market works. How do you think the financial market works? And to me, I think the financial market is actually a mechanism. It's a marketplace, helps the world to distribute the resources from the inefficient ones to efficient ones. And it's a very competitive price. Everybody's trying to do business. It's like a business. And it's very, very competitive. People fighting with each other because it's a zero-sum game. And fighting for business, try to make a profit. And why do you think the market exists? And do you believe in invisible hand? There's people that they don't believe in it. They think there's an intervention by the government, and it's really your belief about the market, because later on you will see that it actually dictates how you trade. And whether the market is random or it's efficient, there's a bit of debate on that as well. Do you believe in cycles? And I believe in economy has cycles, and the cycle is driven by credits. So that's just my market view. And, and I think that market is largely driven by human behavior as well. Now let's go to the self. And your understanding of your self persona, what is your personality? And what lifestyle do you want? And if you want to treat trading as a serious business, forget about the glamorous, the cruise and you sit on the Sunset Coast and have a laptop on your laps doing trading. Forget about that. That's not going to happen. Some of the education courses try to sell you a lifestyle. Trading is a very stressful job. It is a very stressful job. And I have a young family, and I rarely get to see my daughter, and that's just the reality of being a trader. And I have a lot of sleepless nights, and so this is if you look after if you're looking for lifestyle, trading will be a very expensive lifestyle. And how much control you have over yourself? Do you believe that you can control your mind, you can control your behavior? And some people say, I'm not cut out to be a trader, but I can show you that human brain can be rewired, can be trained to be a trader and to tolerate risk. And what trading style do you like? Do you like in and out day trading, or do you like swing trade? And what is your analytical framework? Do you believe in fundamental, technical? And that has got largely to do with your market view. How do you believe the market is behaving? And what is your risk appetite? Now, let me just quickly finish that because, market philosophy can be a very, very personal thing. And so I'm not going to debate mine with yours. There's no right and wrong. You just got to have one. You just got to have one of these because that builds the foundation of your trading. And it guides your behavior. Now, I just said human, we're not designed to be a good trader because we have a lot of behavioral flaws. And for a very long time, there's only one subject in university, which is economics. There's no finance. So the economists are kind of living their own world and dreamland, thinking about supply and demand. And then later it came finance. And they always hated each other because finance is all about dealing real money in reality. And economists, it's all about theory, formulation, supply and demand. So, and for a very long time, psychology has always been the social outcast. It's been a separate subject. It's got nothing to do with finance, and it's got nothing to do with economics. And not until 1970s, and the scientists and psychologists start to think that, well, the theories in finance and economics doesn't work in reality because humans behave in a very irrational way, and all the fundamental market rules, theories, it's all based on human behave in a rational way, which is not the case in reality. So then they combined to come up with behavioral finance, or neuroeconomics, or behavioral economics. Now, we are actually right. There's a lot of study has been done in this area, and there's a few things that we have exhibit behavioral bias. One is cognitive errors, and one is emotional biases. Now, there's a lot of psychologists, they categorize all the behaviors into different categories, but I think this two captures it all. It's really, really conclusive. Now, cognitive errors, it's all about how you memorize things, process information, how you process data, and how you think. And emotional biases is largely to do with your brain chemistry. And it's very impulsive, it's very hard to contain, it's very hard to correct. Whereas the cognitive is very easy because you just have to provide a better education do a better calculation and be more educated and seeking more advice. Now, I'm just going to show you a bit of evidence that we are not designed to do calculation, even the very simple ones. Now, I'm just going to show you how brain handles risk and uncertainties. There's a very famous question called Monty Hall problem. Has anyone seen this problem? Right. So back in the 70s and 80s, in America, there's a TV show called Monty Hall, and that's the TV host. It's a bit of, it's like the Deal or No Deal in Aussie, right? So a bunch of people, they will get into the show and they have to play a few games, and then at the end, the winner will get to choose, will face this question. He will be facing 3 doors, right? 3 doors. And behind the 3 doors, 2 doors will be goats. And behind 1 door, there will be a huge prize, say Ferrari. Goats, you will probably like goats, huh? So that represents something, valueless, and that represents something that is really valuable, right? So he's faced with this question, 3 doors, and when all the things go behind the doors, nobody knows which door has except the Monty Hall, which is the host. So the contestant doesn't know which door contains what subject. So let's say he picked 1, right? He picked 1. And the Monty Hall, the host, will say, okay, well, now you have picked 1. I'm going to show you one of the remaining 2 doors, because obviously he knows which door's got a Ferrari, right? So he's going to show him that, okay, number 3, it's got a goat in it. Now, the question he will ask the contestant is, would you like to switch your decision? Would you like to switch? Now you've got a chance. You can stick with your number 1 selection, or you can change to number 2. What is your call?
Switch. Change. It's no research on it. But you doubt yourself on.
Short of hands. So, how many people will stick with number 1? It's quite a majority. How many people will change? Right. Because the reason for not changing is because people think that, well, it's 1/3 of the chance, right? If you change, well, it's the same. But actually, the answer is switch. You actually double your chance of winning 2-fold, right? And probably none of you will believe this, but I'm just going to show you your winning chance will increase from 1/3 to 2/3 by switching. Now, let's just do a very simple calculation. This is the matrix, okay? So this are all the possibilities that the contestants are facing. If the prize, in reality, the prize is behind door number 1, and these are the options that contestant can choose. If he chose 1, door number 1, and Monty opens number 2 or 3, and by switching to number 3 or 2, the outcome is lose. But the other 2 probabilities, 2 cases, he'll win. Because if he chose 2, right, the Monty chose number 3, and if he changes to 1, he wins. So this just shows you all the possibilities, all the possible outcomes. And you can see in every individual outcome, there's 2 wins against 1 loss. So clearly, you have 2/3 of the chance of winning instead of just 1/3. I believe some of you probably still don't believe this. And there's a lot of mathematicians. Do you believe that?
Yeah. No, because the 2 or 3 should be on its own line.
Sorry?
If he switches to 2 or he switches to 3, they're 2 separate events. They should be on their own line. Why are they joined together? If he chose 1 initially, and then he changes to 2, or he changes to 3, that's 2 separate events. So they should be on 2 separate lines.
2 separate outcomes.
2 separate outcomes, so the probability doesn't change.
There's 4 scenarios rather than...
Correct.
Yeah.
So I'm sticking with the goat.
You're sticking with the goats. Right. But, well, there's a lot of explanations. I mean, there's a lot of debates going on. But But I believe that this explanation, that convinced me. And there's a lot of mathematicians try to work out this problem. And the conclusion is, yes, by switching, you will increase your chance of winning. And I just try to make a point of a very simple question, but actually involves very complex probability calculation. And in fact, we as human beings in life, we make a lot of investment decisions or a lot of trading decisions in life that doesn't reflect the rational thinking. Our brain is just not designed to do this. Now, the brain and trading. So I'm going to show you how brain reacts under the trading situation. So there are two chemicals in our brain that affects our trading behavior. There's one called dopamine. Right. Dopamine is it functions as a neurotransmitter in your brain, and it's related to your pleasure system, reward, fulfillment of expectation, and believe it or not, it's actually related to sex as well. So it's related to reward. So once you get a reward, dopamine levels surge, and it's very addictive. Dopamine is very addictive. That's why people, if you take cocaine, if you take some of the substance, the dopamine level will go very high, very, very insanely high. And, but that's really bad because the brain thinks that that's the new baseline. So if you don't keep taking cocaine, your brain will suffer from depression. And so that's why it explains why trading can be addictive to some people. Gambling can be addictive to some people because dopamine, whenever you win, dopamine level goes up and your body gets addicted to dopamine. And there's another chemical in your brain called serotonin. Now, serotonin is a very naughty boy. If the serotonin level is really low, people suffer from anxiety, depression, impulsiveness, irrational behavior. And if it goes too high, people can feel really, really sick, and it could be fatal. So there's a sweet spot in the middle where people will feel great, feel motivated. Now, when you suffer from a losing position, if you say, let's say you open a position and the position starts going against you, your dopamine level suppresses, right? Because you expect the market to go up, but the market goes the other way. So there's this unexpected event, surprise, that your expectation hasn't been fulfilled. So your dopamine level is really low, and then that suppresses serotonin. When serotonin is low, you're feeling anxiety, you're feeling stressed, and you're feeling irrational. You're feeling irrational. And that's when people engaged in more risk-taking, like excessive trading. Like you want to recoup the cost because now your expectation is not fulfilled. So you want to recoup the cost by taking more risk, doing irrational trading. And so that's how brain reacts when you trade. And so you really have to keep your dopamine and serotonin level balanced. And some of the study actually suggests that some of the investment banks, they should send they should do the daily test of their traders' dopamine and serotonin level, because that actually determines whether the trader will be rational today, and taking the risk taking whether it will be rational today. So there's some natural ways to maintain the level of serotonin and dopamine. And for example, stay away from stimulants like coffee, alcohol, smokes. It's really bad for you. So I've been, that's why I don't drink, because I really need my sobriety, and it really helps me to maintain my serotonin level. And exercising and taking vitamin B complex will help your serotonin levels to stay balanced. And that's very important, because as a trader, you really have to stay rational all the time. And you cannot let the market dictate your mood. Now, let's get into cognitive errors. There's quite a few. I'm just going to go through 5 of them. Those biases, to me, I think it's very fatal to your trading performance. Let's go to the number 1, confirmation bias. Now, Confirmation bias is something that if you have open position, right, and your view of the market or your interpretation of all the technical indicators or market news will bias towards confirming your existing position. Depends on whether you go long or short. So if you have a long position, and you will actively to seek evidence to confirm your existing position. And we do this all the time. If you investing in a certain company, and you will deliberately to ignore all the negative informations, and you will try to actively seek out evidence to suggest that your preconception is right. It's just due to human survival mechanism, because we hate to be defeated, especially by ourselves. So we really have to find the positive confirmations to motivate ourselves to do certain things. And I found that it's really detrimental to traders' performance. And the ways to overcome this the confirmation biases is to have a trading journal. Just to write down your reasons. Actually, for example, I think it's who here's got a trading journal? All right, I got one. I keep track of my trading every financial year. So this is my trading journal for this financial year. And basically, it's a daily record of how I view the market and how I see the market. And when I place a trade, I write down exactly why I placed the trade and my rationale behind the trade. So that if the trade goes against me, and I can go back and look at the journal and say, okay, well, I've made a mistake. The market doesn't behave the way I want it. And also, if you have a trading peer, if you have a trading buddy, it's very good to discuss with him every now and then, and to get him to challenge your view of the market and to challenge your existing position, and to ask questions. So it's very, very important.
So, you know, you said you made a mistake. But you might not have made a mistake, just the market condition changed.
Right. It's actually, now that's, I'm going to mention it later on. I mean, it's a very, very good question, because when a few years ago, when I started trading, right, I always went into the market with the notion that I'm right until the market proves I'm wrong, right? And that's actually I found it very, very deceiving, because now I'm going to the market with the notion that I'm wrong. I'm actually wrong. I'm just making an educated guess. There's uncertainties in the market. It's just a probabilities game, right? I'm wrong until the market proves I'm right. So essentially, having that subtle change of mentality, it helps you to get out of the market much more easier than believing that you are right until the market proves you are wrong. And we'll probably get back to your question probably later on. And second is the hindsight bias. I call it, you know, that's right, 2020 hindsight. It's just a human, it's really just a human brain, because we don't have a perfect memory. And when we look back to the past events, we always extrapolate memories. We don't have perfect memories. So if two people experience exactly the same incident, after 2 years, they will have a different recollection of the actual event. So especially a lot of traders doing technical analysis, and when they look back, try to understand the technical analysis, everything makes sense. Because in hindsight, everything makes sense, right? As if there's, you know, the uncertainties and the market, uncertainties and probabilistic doesn't even exist in the equation, but there's actually certain uncertainties in the market, and when you look back, everything just makes sense. You think that everything should happen that way, but actually it's not. I'm just trying to think actually, this is an experiment that was done about 10 years ago on a group of people, and they asked them the outcome of say, for instance, state of origin. All right? So they want them to make a prediction of state of origin, and which happened in, say, in a month's time. And 40% of people picked New South Wales. Right. In a month's time after the event, and they go back to the same group of people and ask them, what your prediction was. And everybody, I think it was 64% of people thought they picked New South Wales. So we have a false idea of our prediction. We have a false idea of the accuracy of our prediction.
Who won? Did it matter who won if they remembered it?
No, it didn't matter who won. The point is to show that people always overestimate their prediction. Because once the things becomes reality, when they look back, they always think that I have predicted. So they have a false belief of their own judgment. So because in hindsight everything makes sense. And framing bias it's another bias that we fall victim to. And say for instance this graph, if I'm asking you to say whether the lines are parallel, you can hardly tell, right? It's very deceiving. And actually, they are perfectly parallel.
See, that doesn't go.
And there's another example. This is a very classic one. If I'm asking you, these two lines, which one's longer? A lot of people will probably think this one. But if I remove the framing, you'll see that it's actually it's the same. So framing biases affect our trading because risks are not the same in different traders' view. If you just had if you just closed out a losing position, and you will view risk as a very attractive opportunity. And if you just had a winning trade, you will view risk, exactly the same risk, as a threat, because people want to protect their gain. And when they had a losing position, they view the exactly same risk as a very attractive alternative. So that's why you see people go to casinos, and if they lose money, and they'll keep punting. And if they win, then they'll start betting small. And it's just fascinating to see how a frame of mind can change your behavior and how you perceive risk. And there's also another question of framing. Let me just ask you. Well, I don't know whether there's a question here. Let me just. Right. I'm just go through this. Framing biases, sometimes it's actually combined with loss aversion, which is emotional bias. Right, let me just ask you this question. Let's say a disease that's very potential life-threatening, say Ebola. Now, it's expected to kill 600 people. And there's two groups being separated, group samples. And one group, they are introduced with two drugs, drug A and drug B. And those drugs are developed to fight the disease. Now, drug A, 200 people will be saved for sure. And drug B, there is 1/3 of the chance that 600 people will be saved, and 2/3 of the probability that none will be saved. Yep. But 70% of sample being asked prefer drug A because it's a sure win. Now, the second group being asked, being introduced with drug C and D. Now, the drug C, 400 will die for sure. And drug D, there's 1/3 of probability that no one will die, and 2/3 of probability that 600 people will die. Now, only 22% of the people preferred C. But as you can see, number A and number C are exactly the same, and number B and number D are exactly the same. It just depends on how you ask a question, and people will have different reactions. That's just fascinating. Don't you agree?
Well, people using their brain, that's a thing too. People not in their brain.
Yeah, well, there's a book called Think Fast and Slow. So people, they don't really, sometimes they will sacrifice the accuracy of their answers to meet the speed. So they want to make the answer really fast, but because it's just human intuition, because we try to find patterns in everything that we come across. And people really, rarely, you know, slow down and take half an hour to think one simple question. They just intuition. They rely on their intuition, just we as animal. Now let's go back to mental accounting. Mental accounting is something that people do every day. People basically treat money differently. They treat different. They have different compartments in their brain. They think that, you know, say for instance, if you have a salary or asset, you divide certain assets into your savings and certain assets for kids' education and certain assets you will park away for your holiday. And as if, you know, by doing that, you know, the money will behave differently. You know, money is money. And you see this mental accounting in trader as well, because if you start with $10,000 as a trading capital, now in a month's time, now you have got $3,000 profit, let's say. And people will treat this $10,000 and $3,000 differently because they think that, well, I started with $10,000. Now I've got this $3,000 as a profit. It was given, it was gifted. And I didn't start with that $3,000. So therefore, that money can take on more risk. I'm more willing to take on more risk on that part, which is completely irrational. You know, money is money. You should consider that whole portfolio as $13,000 instead of $10,000 and $3,000. And you see this in gamblers. You know, it happens all the time. You see gamblers walking into casino. You know, when they having $1,000 chips to start with, and when they start getting a bit of profit, and they will start, you know, putting that $1,000 in their left pocket, and they will have all the profit chips in their right pockets, and they said, I'm going to bet on this profit money, and which is just completely insane. You know, money is the same. It's all your pockets. It's, you know, so they shouldn't treat money differently, and they shouldn't trade risk differently. So that's just the mental accounting. Now let's go to emotional bias. Emotional bias, we have just mentioned the loss aversion biases. People, the loss behaves, it actually functions more powerful than gain on our brain. It's more painful. Losing is much more painful and to our brain than gain. So it does just, and it's like, how do you overcome this issue? You know, when I experience a losing position, I'm just going to share the experience with you. You know, back in 2008, I started a trading hedging business in 2006, hedging commodities, and I did pretty well, and I had a really good trade during 2007, and managed to go through the first part of the financial crisis relatively all right. And when I get to 2008. I was sitting on the sideline until I think it was the 7th of September, and when the government announced, it was a weekend, I remember clearly, it was on the Sunday night, happening Sunday, America time, and the government announced that they're going to buy Freddie Mac and Fannie Mae, and I thought to myself, this is it, you know, my chance to come, you know, it's a great opportunity to get into the market because now the U.S. government has decided to step into the market, and I should have all my faith on Uncle Sam to rescue the world. So I built up, during the 2 days' time, I built up a large position on our SPY, on our local market futures, equity futures. And on Tuesday, the market opened up in favor. Because at the time, I thought, you know, our market is down 1,900 points from the record high that hit on the November of 2007, and from that, you know, it's down to 28%. So I thought, you know, it's a bargain. You know, I should get in at this price. So I got into the market and I built up a really big position because I had my faith in the U.S. government. And the next day, market went up 300 points. Dow Jones went up 300 points, and I was just so excited because my account just dazzling with green flash, and I remember sitting in front of the screen and I couldn't contain my excitement, and I told my girlfriend, you know, let's get packed, we're going to Europe. And at the time, I lived with a housemate of mine. He runs a day tour company, runs all the daily buses to go to Blue Mountain, and one of his buses had a terrible accident. And he was really depressed. He was really a depressed person. And I told him, you know, don't worry, I'll fix you up. I'll fix your bus. And during that week, the market didn't really go up as I expected, and actually went down a little bit. And I still kind of cling to the hope that it's going to go back to the level. And in 2008, I remember it was the 14th of September. It was on a weekend. For some reason, during that time, everything goes out during weekends. Bloody hell. It was on a weekend, and something extraordinary happened. Lehman Brothers collapsed. And Bank of America decided to buy Merrill Lynch. And it was just extraordinary. And I couldn't do anything because it was on a Sunday, announced on the American Sunday night, and I couldn't do anything. I remember sitting in front of the computer because nothing opened, market hasn't opened, and I was still having this hope that you know, the market would actually go up. And it actually opened on Monday. The Dow opened 400 points lower, and I was deeply in red. But I couldn't admit that I've made a mistake because I was so right about myself. I was so right for the last few years. I was so confident. How can I possibly be wrong? So I had this illusion of control that I can actually somehow, if I hold on to the position, the market will go up. You know, the US government will rescue me and my European trip plan. And the market didn't really turn out to be the way it is. The next few days, it was just the beginning. It actually went down another few hundred points, and it kept going down for another month. So I left with a very unhappy girlfriend and a depressed housemate. So, sorry? I left with nothing but those two. So that's when I decided. Actually, at the time, I had you know, I was on the brink of bankruptcy because in 2006 I bought an investment property and I went into negative gearing, and that was the stupidest thing I've ever done, because never believing anyone telling you to get into negative gearing. That's just one of the dumbest things I've ever done. So I was actually on the brink of bankruptcy because I couldn't meet the interest payment, and I was really stressed. And so I actually refinanced my property, and you know, it was really a disaster. And then I decided, you know, I'm going to London. I really want to get to the center of financial center to learn how to be a real trader. So I went to London in 2009, and I learned a lot. Overconfidence bias. All right, let's just get to that. I love that. Overconfidence. Well, endowment bias. Let's just go to that first. Endowment bias is a bias where people feel an asset is more valuable when they have the ownership. In this instance, you know, even though it's a bloody ugly dog, but the owner probably thinks that it's the most beautiful dog in the world. I mean, anyone who's got kids would have experienced this endowment bias. You know, you see all the moms try to, show off their kids. You know, look at my iPhone. You know, my kids playing in the videos, and people just get sick of it. But they just think that their kids is the cutest in the world. So endowment bias, when, for instance, house, and this bias affects people as soon as the asset is acquired. For instance, your house. People once you bought the house, you will not sell the house immediately for the price you have just paid, right? Because you have the ownership. You think that price now the house all of a sudden should worth more, but actually it's not. And it affects your trading as well, because once you got into a position or once you invest in the company, you think that now the company should worth a lot more than what it is now. So you can't really see the market in a very objective way, and you're sort of thinking that, well, because I own the company and because now I'm having this position, it should worth a lot more than it really is. So this is just endowment bias. And overconfidence bias. The experience that I've just shared with you shows clearly how overconfidence bias can affect a trader's ability to measure risk and to measure uncertainty and to manage your trade. And overconfidence risk, it's actually very, very obvious. You know, when they did a survey on the population, and 90% of the surveyed population thinks that they have above average driving skill. And when they surveyed the university, 80% of the professors think that they have above average communication skills. And when they do the study on graduate students, was something like 84% of students think that they have above average leadership skills. So people would tend to have unrealistic estimation of their ability compared to average population. So that's just overconfidence bias. And that also contributes to traders' illusion of control. Illusion of control, it's a very funny thing. People always think that they have certain control over the market, which they have completely no control of. Let me give you an example. When there was a study done, they asked two groups of people. One is, they asked the people to choose a number from 1 to 50. And whoever chooses the right one wins the prize. It's like a lottery. So they asked the people, the first group, everyone will assign a random number from 1 to 50 and see how much they're willing to pay for the lottery ticket. And the average is $1.50. Fair enough. And when they get to the second group, all right, so the second group, everyone will have, the right to choose a number they want from 1 to 50 and estimate the price, how much they're willing to pay. And the average price is $9. So it shows that it's a completely random event, but just because people just have this false control, illusion of control, they think that, well, they're willing to pay higher price for the false control, which they don't really have. And so that just shows the overconfidence bias have effects on people's investment decisions. Now, how much time have we? Actually, should we keep going or? Yeah, absolutely. All right. Now, let's just quickly go to market profile. That's something that I learned as a future trader in London. I found that it's a very, very useful tool to understand how the market behaves. And market profile evolves based on auction market theory. He actually confirmed, well, he actually consistent with my market belief as well. Market is actually, the marketplace exists as just the sole purpose is to facilitate trade. All right? The market is there to facilitate trade. As many trades as they can. They try to encourage traders to engage in buying and selling with the other parties, all day, every day. So that's the purpose of market. And it's like any other market. It's like any other auction market. You're buying a property, you're buying a car. You can't see the auction behind it because when the car dealers go to the end of the manufacturers, they have to go through this auction process. And if you go to a restaurant, the seafood or whatever food that you consume, essentially was from the auction market. Has anyone been down to the fish market, see the fish auction? Yeah, that's exactly what happens in our economy. Everything goes through auction process. Think of it this way, the market as in general, the price will go up until there's no more buyers. And the market will go down until there's no more sellers. And so, in essence, the market goes up to shut off buying. The market goes down to shut off selling. Imagine this, say there's a corner store down your house. Now, this corner store sells, say, milk. Right? So if this corner store is going to set a price for the milk, if it sets too high, the buyers will refrain from buying milk. And so that the corner store has to adjust the price to a lower level. And it doesn't know where to adjust to, right? So if it's just too low, there'll be a lot more people buying milk. And the inventory will get depleted really fast. So somewhere in two extremes, the corner store has to find a fair price. Where both sides happily conduct transactions. So during that process, the market will go up and down. The price will go up and down. Now imagine there's another superstore, say Coles or Woolworths, open just down the road. Competition comes in. Now, the supermarket will set a price to compete with the corner store. Now, the corner store, all of a sudden, the buyers shift to Woolworths. Now, the inventory starts to build up. So the corner store has to engage in some sort of price promotion to try to sell the milk. So they probably have to come up with like a milk extravaganza or something like that, try to sell the milk. And once they start doing that, the big competitor will engage in the price war. They will start bidding down the price. And because the bigger player has got a much bigger purchasing power, they can afford to adjust the price to a certain level that the corner store can no longer survive. So it shuts off selling because the corner store will set a price. The big market will just make a directional move, say, okay, I'm going to set the price at this level, where the corner store can no longer make money. So it has to stop selling milk altogether. So this is just how the auction market works. It's based on supply and demand and trying to find that fair price. And bearing in mind, you are competing with other traders as well. And this is the 4-step auction behavior pattern. It happens in any market. Let's just take the property market, for instance. Initiation. If you walk into the property market auction, when the auctioneer has just done all the description of the house, it's beautiful, immaculate and stuff. Now, who wants to start to bid? Nobody. All right, he will see a silence. Then he will say, okay, now let's say I'm bidding from a certain price. If he sets too high, and he will still get silence. No one will start bidding. So he has to keep moving the price to invite bidding. So once he moves that price to a certain level, and people start jumping in to the bidding process, and then auction starts, right? And during the auction process, they will try to find a balance. So you will see that they're probably in the 10,000 increments, 2,000, 20,000 increments, and then it will slow down. It will slow down to a balanced level where there's only maybe 2 or 3 bidders left. Now the auctioneers has to step in and try to promote the bidding again. So he will say, okay, well now let's lower the increment, say $5,000. Anyone? $5,000 more? So he's trying to test the strength of the bidder. And then after the test, someone from that 2 bidding parties or 3 bidding parties will make the directional move. Say, okay, I'm going to bid $10,000 more. And that scares off the other 2 bidders. And that auction process completes. So that's just an auction cycle that happens in future markets, forex markets, you name it. Now let's see who's really involved in the auction market. Now, so this is just a full chain of, I've just randomly found it on Google. So in the market, there's different time frame participants. There's long time frame and there's short time frame. Short time frame, and we'll get to that later. So the big predators, they are the long-term frame buyers. They can afford to wait. They don't have to hunt every day. But the shorter frame buyers or sellers, they are day traders. They're in and out. They are algorithm traders and arbitragers. They will have to feed every day, even though the margin is really small. But they are the foundation of the market whole ecosystem. So they're conducting trades every day. They generate the value area. We'll talk about that later. So those big players, they can afford to wait because they want to hunt big. They're looking for profit margin. So they don't really have to compete with the small players. And they can, they are trying to find a fair price, and they are trying to find a advantageous price. Now, the reason why I switched to market profile instead of technical analysis is I do a lot of simulations on Excel. This is just one example, very simple example. I try to simulate the paths, the different paths between 2 points. Say the price wants to go from point A to point B. And those are all the random paths. So in essence, the market goes up, but during the process, you can find different patterns. You can have a reversal pattern. You can have a head and shoulders, and you name it. It's all random. It's all random. The market wants to go from A to B. Right? In between, it does not matter. It's random. There's a lot of noises. And if you try to cover the B, and you try to predict where the market try to go to by analyzing all the random patterns, you're bound to fail. You'll probably be misled. So it's very important to understand where the market is trying to go to. And the market profile provides that insight into where are the value areas in the market, where are the areas where the most business conducted. Market profile is not a tool. It's not a system, buy or sell. It's actually a tool for you to understand how the market works. And actually anticipate the market move rather than predict. There's a difference between predict and anticipation. Predict is you try to estimate the outcome, what's going to happen. But anticipate is you actually have a plan for different market outcomes. You have different strategies for different market outcomes. You just anticipate. There might be a few options, plan A, plan B, plan C. And when the market goes, according to plan A, you do certain things. So you anticipate. You don't really kind of boil down into one prediction. And the market profile is set of principles, not the rules. It's not a 1+1 rules. It's just a principle, how the market works, how the auction market works. And you focus on market behavior, the different participants, rather than a technical indicator. And it focuses on multi-time frame participants, long time frame and short time frame, whereas some of the chartings is just really one-dimensional market price move against time. It's based on auction market theory. It doesn't believe in random walk. So let's say this is hypothetically, this is just a price chart of a certain product. And market profile is actually a charting tool, try to see at what price level the market spends the most time. At what price level the market spends the most time. Now, this is, actually market profile was developed by this guy called Peter Stoudemire in the US in the 80s. And he was one of the greatest traders in Chicago Board of Trade. He traded futures. So when he started, the market profile actually breaks individual trading sessions into different time frames. So every individual alphabetic letter represents a certain fraction of the trading time. Say A represents first half an hour, B represents the second half an hour, and it can represent 15 minutes, doesn't matter. And when you aggregate them, and that's just the price range during that half an hour where the market has been to. And you aggregate all those data together, it becomes a data bank. It's like a normal distribution. So you can clearly, I think this is the bond, the 30-year Treasury futures. And you can see during this day, market spends most time at this value area. That's where the most trades are conducted. And let me just ask you one question. Who do you think are the participants in this value area where the most trade being conducted? That's right. It's the smaller players. It's the short-term frame buyers or sellers. They are, in general, short-term frame buyers or short-term frame sellers. They probably accounts for 70% of market trading volume, and those big players they only account for maybe 10 or 20%. But those 10 or 20% makes those moves, because they are not interested in this area. They are interested in unfair high or unfair lows. Where intraday buyers, they try to trade in this balanced value area because they try to find a fair price. Okay, this is the fair price. They try to bid up and down the fair price. And if the market shoots up, the intraday buyers will get stopped out. And so their survival space is just between this area. So this is what market profile looks like. So typically it will be like a normal random distribution, and this is the value area. Value area is anyone familiar with standard deviation? So during a trading day, you will have your mean. Okay, this is the control area where the most trades being conducted. And you will have standard deviation. So value area is different people have different interpretations. Some people think that 70% of the trading volume is counted as the value area. During that value area means price is being accepted, right? That's why most business is being conducted during this area. And because most people think that it's a fair price, and they like to conduct business during this area. And those extremes is marked as rejection, because market is being rejected at these levels, unfair high and unfair lows. Now, we just talked about the market participants. Let's just see who they are. The long-term frame buyers, consist of hedge funds, investment banks, and index funds. They have to hedge their position. And do they really have to get in now? No. They're willing to wait. They're willing to wait until the market goes to they think it's a advantageous price. And so they're not really focused on execution. They focus on price. Whereas intraday buyers, they try to seek fair price. So they have to respond to the market movements, provide liquidity. They are the building blocks of the market's ecosystem. And short-term frame buyers or sellers, they create balance in the market. And long-term frame players, they create imbalance. They create price extension, and short-term frame buyers, they create value areas. Now, this is generally where the long-term sellers conduct business. And there's different kinds of sellings. Now, when the price moves down to area outside of the value area, there will be two kinds of activities. Either initiating selling, that means sellers will push the price further down, or you will have long-term buyers step in. They think that, well, it's a fair price. They will have responsive buying, and the market will go up. And vice versa here. So, and there's different variations. There's actually 5 variations of market distribution. This one is a normal trading day. Average trading day will behave like this, and you will have your double distribution trading days. So I'm just going to introduce all the different concepts, and we're not going to go into too much details about it. Now, market profile. This is just the one of charting tools that you can use. It's called CQG. That's what we used in London, and you can get it here as well. I think it's only costs about $200 per month. It depends on what product you want to, what data do you want them to switch on. So you can see that this is, I think this is E-mini S&P. You can see that during this trading day, it will show where the business are conducted, and so it's not a normal volume. It's actually try to depict what price area the market has spent most time at. And this is the MT4 version, So I have this on my MT4 platform. So it just shows this is the German DAX, which is I trade on. So this just shows just different market profiles on individual trading days. And I'd just like to show one example. This is, I think it's during the 23rd of October, just last few days. This is where I conduct my most recent trade. So during this market time, I think this is the 24th of October. I actually shorted at 90.40. The reason why I did that is because, so see, this is the normal trading day. And you don't want to conduct business here. If you are a swing trader, I'm a swing trader. I'm not a day trader. I'm not a in and out trader. So I build positions. So this is not the area where you want to build your position, because it's imbalance. It's all the small players, short-term frame buyers. They're conducting business in and out of the market. There's a lot of noises, and as you can see, it's a very distinct distribution. So the market conducts business at this level. In the next trading day, the market actually opened here. So the colors actually indicate, the blue indicates the early trading session, and the red indicates the the end of the trading session. So it shows that this trading day, the market opens here, and it's outside of the value area. And you think that, well, the buyers has stepped in. They try to test the market. They try to push the market higher. And that's where you try to conduct business and make your anticipation. All right? And the market can only do two things. It will rotate back down to a previous value area, or you'll keep going up. And in this case, and you just have to prepare. There's uncertainties. You know, there's no certain prediction. So you just have to anticipate, you know, what the market is going to do. So I anticipated, because according to the fundamental analysis, I think the market's going to go down. And how far it's going to go? It's going to rotate back to the previous value area, around this area. At least have to test it, because that's where the most business was conducted 2 days ago. So see, intraday traders, they will not look this far. They will try to find the value area in the trading day and build a position around it, in and out of position around this. Whereas a longer time frame buyers, I tend to look at different day sessions. So I look at different days and see, you know, a longer time frame. And actually, it was really a profitable trade. And I got in at 90.43, and it got out at about 88.30 something. So it's just a very, just an example that shows you, you know, market profile can provide a very valuable insight into the market transaction and auction process. Now, just a few questions just to basically tell you the key points. What kind of activity forms extremes? Extremes means outside of the value area. It's competition. When there's a competition, buyers keep bidding for the higher price. When there's competition, the market will have an extension, price extension. And value area is built by rotation. Short-term frame buyers, they keep rotating around the fair price because that's in and out of position. That's called rotation around the fair price. And because, as you know, the shorter time frame buyers, they will probably tend to have very tight stop loss. So they will not survive outside of the value area, because if it's a very big price swing, they'll get stopped out and they will stay until the market finds another balanced area. And then they will start getting to the trade again, just to keep rotating and building up another value area. Now, what is the likely behavioral pattern of long-term traders when he trades in the value area? Well, because he's a long-term frame trader, he doesn't care about the price. So he's willing to give in, he's willing to sacrifice on price to get an execution. So he will buy at a slightly higher price, he doesn't care. Selling at a slightly lower price, he doesn't care, as long as he can execute the order. And what is the impact of that behavior bias pattern? Sorry. So it creates a slight imbalance in the value area. The price will push outside of the value area because there's a large volume come in, and which they don't care about the price, and so they will take out a lot of different price levels and the market orders in the system. So you will see a sudden surge in price. That's when the long-term buyers step into the market. You'll push the price outside of the value area, which short-term buyers will never do because that's their survival space. Who creates the range extension? Is the long-term buyers and sellers in the market, because they have enough volume. So they tips the existing balance towards imbalance. Now, there's a lot of different learning sources out there. You can study your market profile. Chicago Board of Trade, they offers extensive materials on studying market profile. Market Delta is another market tools that you can use. CQG, I found it's really good. You know, for any technical analyst, I strongly recommend, you know, check it out. CQG is really good because they have got a very extensive data, and you can do a lot of analysis on that. There's another course, Cisco Market Data. It's different from the IT Cisco company. They actually provide the market profile data as well. Peter Stoudemire, he's the pioneer who actually he actually developed this market profile theory and auction market theory. So go and check out his books. He's got a lot of books out there. Jim Dalton.
From being
by email information that you done?
Oh, you know what? I'll send you. Everyone's got an MT4, right? Yeah. So the previous MT4, the program, I can send you the execution file. You can install on your MT4. You just have to ask one of the guys from Invast how to do that. It's actually a free thing. It just gives you a taste of how the market profile works. It's the simplest form of market profile. It can get really, really complicated, but it just gives you a taste. And you can just install on MT4 and just start observing how the market behaves according to the trading volume and trading behavior. And Jim Dalton is another pioneer. So these two guys, check out their books. He's written a book called it's Mind Over Market. It's really good. So just to conclude with a quote, before you speak, listen. Before you write, think. Before you spend, earn. Before you invest, investigate. Before you criticize, wait. Before you pray, forgive. Before you quit, try. Before you retire, save. Before you die, give. So thanks. And I would like to listen to your trading strategy as well. If you have a proven one, if you'd like to share some of the market views, this is my contact details. And I'll probably leave my business cards here. And you can, because we always look out for good traders. There's good different trading strategies, and our clients would like to learn different trading strategies as well. And so if you think that you have got good, a good trading strategy, please let me know.